Is this the beginning of the next big financial crisis? Last week, we had the collapse of crypto-friendly bank, Silvergate, and this week we had the first collapse of a huge traditional bank, Silicon Valley Bank. And as we've been discussing since mid-2022, the entire global financial system, crypto markets, stock markets, bond markets, US banks, international banks, all of it is inextricably intertwined. And the crypto fallouts of last year with Celsius, Voyager, Three Arrows Capital, FTX, all of those dominoes were headed to the traditional financial sector. And now it's here. Silicon Valley Bank going bust is the biggest bank failure we've experienced since the 2008 global financial crisis, and it's the second largest US bank to ever go down. This is just the first traditional finance domino to fall, and the reality is that most of the US banks are in the same situation as Silicon Valley Bank. They just haven't had a run on them. If enough people got spooked and started withdrawing their deposits, the same exact thing would happen with any bank. It would collapse. And this contagion will undoubtedly cause more dominoes to fall in the coming months, weeks, and probably days. Because some key differences between the 2008 financial crisis and the one that is likely underway is that information spreads extremely fast due to everyone, for the most part, having smartphones, internet connections, and access to news, social media, and other means of instant communication. Here's how the second biggest bank collapse in US history happened in just 48 hours. The company's downward spiral began late Wednesday, when it surprised investors with news that it needed to raise $2.25 billion to shore up its balance sheet. This was a hysteria-induced bank run caused by VCs. Ryan Falvey, a fintech investor of Restive Ventures, told CNBC. All told, customers withdrew a staggering $42 billion of deposits by the end of Thursday, according to a California regulatory filing. Yes, information spreads quickly in this digital age. And while some are saying this may be an isolated event, nothing to see here, as one bank folds, another wobbles, and Wall Street asks if it's a crisis. More lenders are struggling to keep deposits from fleeing. Silicon Valley Bank is just the tip of the iceberg. Yes, this is likely just the tip of an extremely big iceberg that the Titanic, that is the global financial system right now, has already hit. It's a sinking ship, taking us all down with it. Why is it so? Well, the short answer is because the Federal Reserve keeps raising interest rates. So let's explore the longer answer that's a lot simpler than we would think. Hello, I'm Crypto Casey and welcome to another episode of Crypto This Week. Let's take a look at the global news stories and the state of the current macro environment. Please check out our sponsors CoinLedger, NordVPN, and Ledger. Start getting your crypto taxes sorted out with CoinLedger's cryptocurrency and NFTs tax software that will save you time and help maximize your refund. Secure your data, privacy, and access to important financial and cryptocurrency accounts from hackers and trackers by using virtual private network services provided by NordVPN, which we can redeem for a special discount with the link below. And please make sure you are taking complete control and ownership of all your digital assets and cryptocurrencies by using secure cold storage hardware wallets like Ledger devices. So make sure to scroll down and use the links below to access the correct and official sites, as well as redeem any special offers they have for us. Sweet. So when we deposit US dollars into a bank account, the bank doesn't keep it in cash. They lend it out to other people and businesses, or they invest it. And they usually invest it in US Treasury bonds, or T-bills. US Treasury bonds in finance are regarded as one of the safest investments available, and so it makes sense that many banks buy them in order to generate some yield on our deposits. So banks that bought long-term 10-year Treasury bonds over a year or so ago, when interest rates or the cost to borrow money was zero, they were getting 1.5% or so income from the investments. Now that the Federal Reserve has increased interest rates higher and higher over the past several months to 4.5% plus, all of the bank's US Treasury bonds are worth less than what they originally bought them for. So they are sitting on massive losses. So a key fact we should all keep in mind as investors is that the value of US Treasuries decreases when interest rates go up. And since banks invested their customers' funds into these long-term bonds that at one point were maintaining their value and generating yield, while in the recent short term, interest rates have increased faster and more aggressively than the market has seen in decades. Most banks are underwater. However, just like we saw with Silicon Valley Bank, the problem gets exponentially worse when depositors run on the bank and try to withdraw all their funds at once. Because since the banks don't keep a lot of cash on hand, in order to give depositors their funds, they are forced to sell their treasuries at a loss. So when a lot of people start withdrawing funds all at once, it causes the bank to go insolvent. Now, there are financial instruments like rate swaps that banks can use to hedge against rising interest rates, but for some reason, Silicon Valley Bank did not do this. And as they were one of the top 20 largest banks in the US, it's best to go ahead and assume that a lot of other banks have not been hedging either. Scary. So the fallout from this particular bank largely affected a lot of tech startups, founders, and venture capitalists, who will have problems making payroll and staying afloat in general unless the government or another bank swoops in and saves them very soon, which doesn't look like the case right now. However, in response to this tweet, I think Twitter should buy Silicon Valley Bank and become a digital bank. Elon Musk replied, "I'm open to the idea. That would be something," and as we discussed in previous episodes a few months ago, Elon Musk wants to add the ability to transact value on Twitter, so maybe acquiring a bank would jive with his plan. We shall see. At the end of the day, although this is a bad blow for the tech sector and innovation at large, this could not have been a better wake-up call to a better group of people, because people in tech will absolutely start using cryptocurrency and will likely start building and innovating in the space, which is what we need. There are not enough developers in the space, and the collapse of Silicon Valley Bank could have just inspired a new wave of tech talent to join the industry. And some of the tech companies affected are already here. Check out this tweet. Seeing private messages from crypto startups saying, "Yes, we banked with Silicon Valley, but don't worry, we diversified into ETH so we can still make payroll." Imagine using ETH to hedge against dollars in your bank account. Strange times. Who could have predicted it? Very interesting indeed. Unfortunately, due to the interconnectedness of the entire financial system, the crypto space has also been severely affected by the collapse of Silicon Valley Bank. Stablecoins have been losing their peg. Uncertainty stands around multi-billion-dollar USDC empire as issuer Circle held reserves at Silicon Valley Bank. Circle's USDC instability causes domino effect on DAI, USDD stablecoins. Following USDC's depegging, 3 stablecoins, DAI, USDD, and Frax, also depegged from the US dollar. And to make matters worse, Coinbase made the following announcement: "We are temporarily pausing USDC to USD conversions over the weekend while banks are closed." During periods of heightened activity, conversions rely on USD transfers from the banks that clear during normal banking hours. When banks open Monday, we plan to recommence conversions. Yikes. And at the time of this video, USDC hit a low of 87 cents and is now sitting at about 94 cents. So as we can see, there's risk with keeping our cash in banks and in stablecoins, regardless of whether we have them in our own wallets, because of the banks stablecoin providers like Circle keep their reserves in. So what can we do to protect our money we need to live off of, need for liquidity, and need for staying on the sidelines for investment opportunities? Well, there are a couple of things. 1, make sure we are keeping less than $250,000 in each bank account, so it's below the maximum FDIC insurance limit. But even with FDIC, if there was a big systemic banking problem, there would not be enough to go around. 2, we can consider diversifying into treasury bills, which, while being safe, also generates yields of up to 5% right now. 3, we can consider diversifying cash into credit unions, as they are structured differently than banks in that they are not-for-profit financial cooperatives owned and controlled by their members, while banks, on the other hand, are for-profit institutions owned by shareholders. And fun fact, credit unions have been statistically less likely to fail in the past. According to the National Credit Union Administration, NCUA, which regulates and insures credit unions, there were 19 federally insured credit union failures between 2016 and 2020. During the same period, the Federal Deposit Insurance Corporation, FDIC, which regulates and insures banks, reported 137 bank failures. So banks failed more than credit unions by a factor of 7 during that time range, which is interesting to know and consider. Cool. So those are some options to consider if we need to stay as close to cash as possible with little volatility as possible. Other options include diversifying into semi-liquid assets with more price volatility like stocks, bonds, gold, and of course Bitcoin or Ether. Something extremely important to keep in mind is that hackers and scammers love to exploit events like the collapse of Silvergate, Silicon Valley Bank, and more by sending out emails, texts, and all kinds of messages pretending that your accounts or similar have been compromised. Then they try to get you to send them information about yourself like usernames, passwords, two-factor authentication, wallet, seed phrases, private keys, etc. Or sometimes they say you owe fees or need to send them money or crypto to retrieve your funds or to protect your funds or similar. They also set up fake websites that look the same as your bank, crypto exchange, or similar to try to steal your login credentials. And when we panic, we tend to freak out and try to act quickly, and that substantially increases our chance of being scammed. So make sure when we are looking to make some moves to protect our funds and digital assets to always stay calm, go slowly and carefully, and always double and triple check website URLs. And to help protect us in our wallets when transacting online, there's a free browser extension currently in beta called Wallet Guard that acts as a security companion to our crypto wallet of choice. so we can browse the internet and interact with Web3 more securely. I've been using it for the past month, and it's been working great so far. Popping up warnings, helping check everything out before transacting, so definitely worth checking out and giving it a go in this crazy macro environment. WalletGuard uses machine learning algorithms to detect phishing before a scammer can access your crypto assets. In their most recent update, the app now offers multi-layer protection services for our wallets. So when interacting with smart contracts like minting NFTs, when accessing the site, WalletGuard's phishing protection layer executes and warns you if the website might be harmful, if it was created recently and has low trust, and if you proceed to do so with caution. And when we do, before attempting to verify a transaction with our wallet, a second layer of protection is executed with a clear human-readable warning about what exactly will happen if you decide to proceed with a transaction, like if it is going to drain your wallet instead of actually mint the NFT. It can also detect and will notify you if the site is making multiple attempts to interact with your wallet, trying to hack or steal your funds. So WalletGuard is basically an all-in-one security dashboard for Web3. So make sure to scroll down and use the link below to access the correct and official site to download WalletGuard's free extension to protect your wallet and crypto assets today. Nice. So in light of all this bank chaos caused by the Fed, what will be their next move? Savage Finn Henrik tweets, usually they cut rates at times like this, and now we are seeing more headlines like this. Financial system risks put a smaller March rate hike by the Federal Reserve back in play. Why is it so? Well, as we've been discussing on the channel, the Federal Reserve is only going to stop increasing interest rates if one of two things happen. 1, we reach their 2% inflation target, or 2, something big breaks. And the Wolf of Wall Street's nailed it in this tweet. Well done, Jerome Powell. You broke something. Now you can smile and pivot, since bond yields and bank stocks are crashing. So is it possible that my random wild guess I made a few months ago about hitting the market bottom March 25th going to play out? I'm not sure. We shall see. Jerome Powell will announce the Federal Reserve's interest rate decision on Wednesday, March 22nd. And considering the speed with which a top 20 US bank collapsed, a mere 48 hours, a lot more can happen over the next week and a half. Let me know what you think the Fed is going to do in the comments below. Cool. If you've been watching some of the latest content, you know that I'm pretty skeptical about the Fed's ability to successfully launch and enforce globally their FedNow central bank digital currency system. And this tweet by Caitlin Long is an additional thing to consider in light of recent events. If you think bank runs happen fast, just wait until FedNow comes online later this year. Today, withdrawing demand deposits takes hours via FedWire or days via ACH. FedNow will be real-time 24/7 365, limited to 100K at first. So banks will inherently need to be less leveraged and hold more liquidity. Yeah, banks are not going to like this system at all. So we shall see. In the meantime, this bank failure, stablecoin scares, and increasing interest rates is further putting people off the US dollar. The US government and regulators are destroying any chance the US dollar has at remaining the world's reserve currency in the long run. And at the end of the day, this is all bullish for crypto. Bitcoin and Ether are the future of the internet, the future of money at large. It's the only way we can truly own and control our assets, and these bank failures are a huge wake-up call for the world and a huge highlight of crypto's use case. Despite all the craziness, Bitcoin and Ether have held up well because people and countries are starting to realize the importance of a worldwide, neutral financial infrastructure, as it is truly freedom money. The value of US dollars are constantly inflated away, becoming worth less and less every day. Banks are only open weekdays, 9 a.m. to 5 p.m., except on every holiday known to man. The government can freeze and take our US dollars anytime, and banks can collapse in a matter of hours, losing all of our funds. When we deposit US dollars into a bank, we are unknowingly giving an unsecured loan to a heavily leveraged borrower, the banks. We need to do our part by spreading awareness about how the financial system works and the importance of crypto, so we can try to build a better future together. Awesome. If you would like to learn more about the implications of a US central bank digital currency and why it's important to spread awareness about it, check out this video. If you would like to have that Eureka moment and finally understand how wallet phrases, private keys, and public addresses work, check out this video and use this link on the screen here for a free download of the WalletGuard app extension to protect your wallets today. Like and subscribe for more. Be safe out there.